So everybody, thank you very much for coming in for another happy hour. Sponsored. Oh, we don't have a sponsor. It's just us. Okay. So the ETF Think Tank. I'm Dan Weiskopf, otherwise known as the ETF Professor, a portfolio manager at Tidal Financial Group. So thanks very much, John, for joining us here. So Mike, do you want me to kick it to Cynthia and then to John, or I didn't follow you? Cynthia, please introduce yourself.
Yeah. This is what happens when we try to script beforehand. We forget the script. So hi, everybody. We missed you all last week. Excited to be back this week. Cynthia Murphy, head of research for the ETF Think Tank. We're really excited for the show today. We have a great guest joining us today, John. I'll let Mike go next, and then we'll let John introduce himself.
All right, Mike Venuto here. I'm dealing with all the technical stuff in the background today. Happy to see you all again. As usual, we like to have a toasting word. Today it's going to be activist. So you hear activist, have a drink with us. As we go through, you can DM me in the chat. I'll get you moved up here if you want to be speaking. I also put in the side here the Twitter feed in case you want to share it with anyone. And our guest also has a book that I'm going to put the link in here too for you folks. So let's get started by introducing John O'Connell. John, you want to introduce yourself to the team?
Yes, thank you so much for having me. I really appreciate it. My name is John O'Connell. I'm the Chief Executive Officer for a company called the Oasis Group. And I'm also the author of a new book called The Rise of the Activist Investor.
Well, I thought you were going to give us a lot more. so
So
I'm
what is the Oasis Group?
Yeah.
Let's start there.
What's the book about? Come on, this is the easy softball.
Let me dive in. I didn't want to be too forward. So the Oasis Group, we're a technology and consulting firm. We primarily work on one side of our business with asset managers, independent broker dealers, and registered investment advisors. And on that side of our business, we help a lot of those firms in figuring out how do they want to go to market, what do they want to do to be able to grow their business, how do they want to create a technology stack around that. And in some cases, the market's done really well the past couple of years. So in a lot of the cases, those firms have bought tons of technology. And now they're taking a look at that technology and saying, hey, wait a second, are we using this effectively? And maybe we should right-size some of this technology. So we help a lot with those types of projects. On the other side of the business, we work with a lot of fintech firms to understand what they can bring to the market so that when we work with our registered investment advisor clients and the independent broker dealers, the asset managers, we understand what we can bring to bear to solve some of their challenges. The Rise of the Activist Investor is a book that had been in my head for about 5 years. I've been in finance my entire career. I started my career at Merrill 1 billion years ago. The book took me about 14 months to write. And what it examines really is, what are some of the trends that we're seeing in the market today around, with the rise of a lot of ETFs that are really more socially responsible investing or ESG investing or faith-based investing, the growth of that. And then what are we seeing with the access to the markets and a lot of the social movement that you've seen over the past decade? And how does all that come together to have the rise of a new class of activist investors, which are not, what you would commonly find in just hedge funds or what you would find in some of the more famous activist investors that are individuals, but how does that translate into retail activist investing?
There you go. That was a lot more.
By the time I'm done today, everyone's going to drink a lot when I say activist.
Yeah, I missed a couple of those.
So can I start with a really dumb question, which is when we talk activism in general today in the ETF space, good thing I'm not having alcohol today because this is a really fast drinking pace. Is it necessarily associated? Does it have to be necessarily associated with ESG or values-based in general? Because in theory, you can feel really strongly about any company you invest in, and you want to give a voice to your dollar invested in that company. But we tend to just associate with this ESG conversation. Is that how we should think of this?
No, I don't think that's the only way to consider it. And in the book, I actually invented this arc. It's called the activist investor arc in the book. And it starts out with a passive activist. And a passive activist is someone who they're not really participating in ESG or SRI ETFs or anything along those lines, but they're interested. So they've got a knowledge or they're interested in it. They feel that they would like their money to more accurately reflect their value set. And then at some point, they learn a little bit more and they become what's called a casual activist. And that's where they'll start taking a look at either an ESG fund or an SRI or a faith-based ETF. And then that they'll casually invest in that, but they're probably still not voting, right? So in those cases, a lot of times you don't have pass-through voting capability, as you know. So you're really casually investing as an activist at that point. Then you move into more of an active voter. And an active voter is where you're going to start choosing companies that really follow your value set. So you may have a large portion of your portfolio that's still traditionally invested in ETFs and mutual funds and things like that, but you're dabbling in some individual stock ownership, primarily because you're becoming an active voter. You want to get the proxy, you're voting according to your values by that proxy. And then you move into more of a beginner activist where you're not investing anymore just separately. You're really focusing on having investments that just match your value set. Then you can move into an influencer activist where you're beginning to get like-minded people to listen to your viewpoint or to be influenced by your viewpoint. And then finally, you become this professional activist. And the professional activist is what you would find more traditionally, where these are the folks that are banding together with other like-minded people using technology in many cases, like Discord. And I go through a bunch of examples of that in the book. But these are folks that are actively grabbing like-minded people, buying shares together, using their collective buying power to amass a certain amount of shares, and then ultimately promoting their values with the company through proxy nominations and proxy votes.
So, in the beginning, before we jumped on live, I was asking you about a couple of tech platforms that I've either participated in or have been talking to the owners, because this is the ETF Think Tank, right? So we are a pooled investment vehicle, and we have some pretty, outspoken, I don't like to call them ESG because I hate that term, but we have the Social Justice Fund with Adesina, and they're very outspoken about their opinions. We have a whole suite of the largest Sharia funds. And then we have the other end of the spectrum, like the orphans, which are leaving out things, or y'all, which he believes that you should only be investing based on the investment part. So he's got an opinion as well. Tell me about some of the tech platforms that you've seen out there that you think are interesting that help get to the shareholders even when they're in a pooled vehicle.
So we talked a little bit about some of them, right? You see, there's number one, the fact that we're seeing a lot of these particular technologies come to market at this point is very interesting, right? I mean, if you would have thought about this a couple of years ago, you wouldn't have considered a lot of these technologies that are coming to market. But if you take a look at some of the direction that you're seeing, right, you're seeing this confluence right now between this socially conscious investor. But if you think about what we've seen just in the past decade, we've seen more social change in the past decade than you've seen pretty much since the 60s. That all started with Occupy Wall Street. I'm a New Yorker, so that kind of hit close to home when that occurred. So you had Occupy Wall Street in 2011, and then from there you saw like the Dreamers, you saw the LGBTQ plus movement, you saw Black Lives Matter, you saw justice reform, you saw the Women's March, which was the largest protest in US history, and then you saw the Me Too movement. So we've seen in this past decade, young investors that are coming up, or even more socially conscious investors that have seen the power of a voice in a social movement. And they've seen the ability for that voice to be heard and drive change. Merge that with the race to zero, where trading right now can be done in the palm of your hand at virtually no cost. We can discuss whether or not there's back-end cost to all that. probably for a long time. But the fact of the matter is,
we're just going to call it undisclosed cost.
We'll
right?
just call it, yeah.
We're losing transparency on the trading, and we're getting transparency on our shareholder ownership and advocacy. Yeah. So
exactly.
Keep going.
But you look at Robinhood, Webull, some of those technology platforms that are available to people, right? Even take a look at the Betterment, Sophies that are out there that are really giving access to the markets in unprecedented ways. You can have access to the markets today without working through a brokerage firm, a traditional brokerage firm, right? Which would have been unheard of when I was at Mother Merrill. No one would have thought you could do that. So you're seeing that kind of access in the market. And then you're seeing this big explosion in more of these ETFs and mutual funds that are available out there that enable you to have ESG, SRI, and faith-based investing. Couple all that together, and that's where you're now seeing public come out. You're seeing seeds investors come out. You're seeing a lot of these products that are coming out that are really enabling investors to get in there and have those investments match their values. So I gave you that background because I don't think any of those applications would have gotten venture capital funding if you didn't see this confluence that I kind of outlined in the book. Otherwise, who would give them money to go build a platform like that? Unless they saw this need and this trend that I think is coming very quickly.
Dan?
Yeah. By the way, I'm so happy to hear so much enthusiasm about ESG. I have to say, because I hear a lot of other views. Let's just say that. So, and I think the model makes sense, but let's be honest, it's controversial. So, without inviting a lot of negativity on the show, because I don't want to hear negativity today, and it's not allowed. Do you think we need clear definitions, or really, according to you, activism is inspirational, and that's what it's really about?
I think I'm of two minds on that, and let me explain that comment for a moment. I think activism is inspirational, and I think people should look, regardless of what you think about today's political environment. Companies still run as a democracy. The shareholders elect a board of directors. The board of directors hires and fires the CEO, and the CEO hires and fires everybody else. The direction of a company is not set by the CEO. Now, we have corporate governance challenges where CEOs are also the chairman of the board. So it's like, so wait a minute, I can hire myself. Let me look in the mirror and say whether or not I want to hire myself today. Those are other challenges that I think you see in a lot of different companies. But the reality of it is the shareholders really do get to set the agenda of a firm. And then the CEO, it's in the name, Chief Executive Officer. They execute on the will of the shareholders. They execute on the vision that the shareholders would like to see. So I am an optimist when I look at that and say, I believe that 100% is true. And that's the foundation of our financial system here in the United States. And quite frankly, what the world models themselves to be, which they model themselves after our financial system. That being said, ESG has a lot of controversy. So does SRI, and the reasons I think are there are not really standardized views of this data. Right. So talk to any ESG provider, and they will talk to you about holes in their data, a data provider. The holes that they have in their data are there's no requirement, for example, for disclosures around climate, carbon emissions. Great example, right? Here's another great example. You're not going to find a lot of ADRs that will have great carbon emission data, especially if they're coming out of some more industrialized countries that are not going to report that. So I think the holes in that data cause a lot of people to see the problems with any kind of activist investing, whether that's an ESG investing and SRI investing. That holes in the data get people to look at it and go, well, there's greenwashing. Well, there is. There's not a full data set today. But I think the fact that you're finding so many companies that are creating ESG products, and you're seeing so much discussion around ESG products, even though when you take a look at ESG ETFs, they're less than 10% of the total AUM invested in ETFs globally. But the fact that there's so much discussion around it strengthens my argument in the book, which is this is a trend that we're seeing that's going to continue. And the fact that there's a lot of people discussing this so vehemently, I think is actually fabulous, because that's how you're going to see change.
Yeah, you just said 10%, so I'm going to check real quick because
it's less than 10%.
It's got to be. I'm going to guess it's
significantly less.
Yeah, I'm going to. Anybody can do this. You can go to etfthinktank.com. We have our tool to pull this number up. All right, so let me just see what it is.
I'd say you're probably going to be around the 5 or 6% mark.
Not even close.
Not even, much lower.
Well, so you know what? Maybe globally. So hold on.
Yeah. You got to look globally, because what you find in Europe is like a large portion of the inflows in 2022 in Europe have been in ESG ETFs.
Yeah. So this is US data. So $74 billion.
That's like nothing.
Yeah.
That is next to nothing.
Yeah. Now this is just generic ESG. That doesn't mean it's some like specific ESG cause. These are funds that state that they're ESG.
ESG.
Yeah. So, you know, that doesn't always include some battery technology or, so, because personally, I think the term ESG is the worst thing that ever happened to the movement. Because it's like smart beta was for the ETF industry.
Yeah.
They didn't know what to call it. So anything that wasn't like passive market cap stuff, they called it smart beta, and it made it impossible to slice and dice and lots of confusion. But something that really got to me in what you were describing, and actually I give John Lekumnik, I don't know if you probably ran into him in your research at some point, but years ago I wrote a piece on how Vanguard at the time had, $1 trillion, whatever. And they had one ESG fund that they voted like an ESG fund, and a gazillion other dollars that they voted just for whatever ISS told them to do.
Yep.
And it was like giving money to Vanguard was actually anti-ESG at the time. Lekumnik was one of the biggest voices against that. He's on Van Eck's board. He wrote a book recently too that argues that ESG investing gives us 200 bips a year because it prevents wars. I was like, John, you've got a thesis that I need a time machine to prove, but way to go.
Or disprove.
Or disprove, yeah. Yeah, I mean, it's a great thesis. Like, hey, ESG prevented wars, whatever. But what really stuck out to me here is, and what I'm coming back to, is investing ESG without activism is kind of pointless. Like, who gives a crap that I don't own Exxon if I'm not going to do something? Even just the act of talking about it or being part of a group, that's doing something, right? Language creates thought, right? That's where reality comes from. It's the discourse. I won a bunch of college debates with that argument. So the activism part seems to be way more important than who said this stock is ESG, right? Because, there are LGBTQ ETFs or indexes, and then there are Catholic values. Their S are completely different, right? So it's the activism part that matters. Now, I said activism 4 times, and I'm not sure what the question is, but fire away, John.
We were wondering too, by the way.
I went on a ETF professor stream of consciousness. So
I think you're right. I think that the activism is what really matters, right? The arc that I created for the book. So the way that the book is set up is it really follows a young investor as she learns about activist investing and becomes more and more involved in activist investing, right? And then ultimately she forms an investing group, and they do target specific companies to drive change within those companies. So the book is structured where the first portion of each chapter follow her story and what she learns, and then the second portion of the chapter talks about the practicalities of how does this really work? What's the history behind it? How do you do this thing? When you think about the ability today for the groups to really get together, right? In the old days, it would be harder for groups to get together because we didn't have as much social media capabilities as we do today. in the book, I actually outlined where Eileen, the protagonist in the book, where her group starts on Discord, right? Very, very popular service, that enables people to do active video and discussion groups and audio just via Discord servers. That ability to get together and just talk and figure out what is going right with the company, what is going wrong with the company, getting like-minded people into a discussion around the company, that's what's really going to drive any kind of change that you want to see, right? So I agree with you. I think ESG in and of itself is kind of doing the whole movement, if you will, a little bit of a disservice in that it's just a big label that you're putting on something that's much more complicated than 3 letters.
So can I ask a dumb question, which is if there's any downside to this? Because I think the concept of like-minded is already a minefield. As we know, everything is very polarizing today. And if you think from an actual, pass-through proxy voting, like, giving like direct voice to your dollar, is there a downside to this? I mean, if we're talking about, this kind of opening of the gates for everyone to be an actual voter on what happens on a company, is the assumption that we all individually know what's best for that company, or we're going to start just destroying businesses because we can't agree and we can't make up our minds, and we end up paralyzing important decisions with all of this? Can the voice become too much noise?
Oh, Cynthia, it's like you want an electoral college here. It's funny. Tumelo, the one that we were talking about earlier, one of these technologies, it has that ability to get the opinion of all the people in your fund, right? So on the various stocks, and then it's still left to the manager to make the decision. So it is kind of an electoral college. We have not elected to do that because I don't want to be making those decisions yet. But I think it's a good question, though. It's not a dumb question. Stop calling your questions dumb. So what do you think? Is it dangerous to give the lunatics the keys to the loony bin?
I think, if you think about the old adage, right? Power corrupts, absolute power corrupts, absolutely. So if you do swing too far, I think in any portion of a pendulum, you're going to find the bad, right? So that's one statement that I'll make. The second one, though, is if you take a look at the number of people that are really just going to, let's just call it what it is, the number of people who are actually going to get off their behind and sit down and read a proxy and then vote and take the time to write a proxy and create a proxy. These are people who truly care about the company, right? These are not, you can't mail it in when you're going to go write a proxy and put that up and try to drum up support within a shareholder group to get a proxy passed. You're passionate about what you're doing. Otherwise, you would never take the time to do it. It's not like someone's paying you and says, well, you know what, we're going to put you on payroll to go write a proxy to be able to do this. You're doing it really as, just because you care about the company as a shareholder. And I think that if we can find enough people who truly do care about the companies and the direction they're going in, I think we'll be in a better place. I don't think that we'll find, you're going to find too many on the other side. That being said, there is precedent for this, right? Take a look at, for example, corporate raiders as the corporate raider, trend happened most notably in the late 80s, right? Here was a great example of people who were able to amass enough shares, were coming into a company and breaking up a company, whether the company liked it or not, right? And that had a real detrimental effect, I think, on a lot of people's jobs and things like that. Think about what happened at Procter & Gamble, which I actually cover in the book. Procter & Gamble came under a hostile proxy to be able to break up Procter & Gamble. Who's the biggest shareholders of Procter & Gamble? Ex-employees. Those ex-employees got together on Facebook and stopped the, quote, activist investors' approach to breaking up Procter & Gamble and brought them to the table to discuss how do we restructure the debt of the company as opposed to having to break the company up. So I do think that you can find, bad examples, if you will, quote, bad examples, although one could argue from a capitalistic only perspective, is breaking up a company that is not performing correctly a bad thing. maybe not. Depends on your point of view. If you're the employee, probably a bad thing. If you're not the employee and you're the shareholder, probably a good thing. If you're both, who knows? So I do think that you can find examples in both places, Cynthia. What I find really energizing, and where I think that I'd love to see more and more of it, is people who do actually care enough to turn around and say, I don't agree with the direction of this company, or I don't agree with the say on pay, or I don't agree with the expansion that they have. So I think we should do something different.
All right, so I'm going to stay on this corporate raider thing. So I'll go. Damn, my hand's up. I don't know where your hand was. So there's a question in the chat from Warren about, do you got to be a lawyer to do this? Is it really successful to do this? And you and I talked before this about somebody who used to be a corporate raider. And you said for 50 grand, he made a difference. So I'd love for you to share that story, just because the idea that it takes being a lawyer and all that sort of stuff to do this, I don't think is true anymore.
No, it really isn't at this point. If you think about Carl Icahn.
Yeah, Carl Icahn.
Clearly a well-known corporate raider. Carl Icahn's daughter is an animal activist. He was able to, for an investment of $50,000, be able to launch a proxy, and his daughter is now on the board of directors at McDonald's. Okay. Now, since joining the board of directors of McDonald's, McDonald's has announced a brand new packaging that's going to be coming out of McDonald's that's more eco-friendly than the normal packaging. If you've ever eaten at McDonald's, it's pretty much paper that's covered in wax, and it doesn't really biodegrade very, very easily. She was able to get on the board of directors with the help of her father, amassing a very small, number of outstanding shares, and is now driving change through that company. Now, so that's not a lot of money, right? If you have a group of investors that can pool together, you can very rapidly register as a wolf pack. That form is incredibly easy to do. When you amass a certain amount of shares, you can register as a wolf pack. You can go through an SEC registration, and now it is public that you own that number of shares, that percentage of the outstanding shares of the company. I would argue, quite frankly, it's easier if you're not a CPA and you're not a lawyer. And the reason is, if you're a CPA or a lawyer, I worked at KPMG for many, many years. We couldn't own a direct position in anyone that KPMG audited or anyone that was part of our consulting team, right? So in other words, I couldn't hold a direct position in almost any company because at the time I was there when it was still the big six. So, before Arthur Andersen's change of the industry, if you will. So I would argue it's actually easier if you're not an attorney or you're not a CPA. And quite frankly, if you're not a registered person in the industry, you're under no restrictions at that point, other than the restriction of disclosing to the SEC when you've amassed a certain number of shares. So I do think that you don't need a lawyer to do this. People are doing it today, and they're doing it for in a lot of cases where they don't have a huge amount of investment capability. They're banding together, they're creating an investment vehicle together, and then they're going in and buying enough shares to do it.
All right, Dan.
Yeah. Polarizing is a great word, by the way, and I don't want to go off on a tangent like other people apparently, but I often
is that a dig at me?
No, I wouldn't say that. But I don't want to. You kind of inspired me to think about like Bitcoin in the context of not ESG. Don't call me crazy, but activism, right? Let's stop U.S. dollars printing. That's the message that they're trying to communicate. But I want to stay on point, actually. Here's my question. We work. Well, I don't know if I'm gonna get a second opportunity.
Well,
Mr.
let me
Michael,
just get a drink first. Let's go.
Activist.
So here's my question. And I think you're never supposed to ask a question if you don't know the answer. But I'm going to do it anyway. We work with a number of ETF issuers who have ESG solutions, right? Do you have anybody who you think does a better job or worse job in trying to work through the ESG issues?
I think when you take a look at, again, the biggest issue that you come up with a lot of ESG, the criticisms you find with a lot of people who look at the individual holdings that are in an ESG fund tend to be around, well, you say that this is a low carbon emission fund, but McDonald's is in it, okay? And McDonald's buys cows, and cows create cow poop, and cow poop is a terrible emission, burns holes in the ozone, right? So when you look at that, the reason that you find some of these anomalies in the ESG funds is primarily, again, it's this lack of real consistency around the data, right? So I think when you look at folks like MSCI, like Sustainalytics, like Owl ESG, that are really endeavoring to build a very consistent data set, and these people are working tirelessly to really come up with more insightful data, that's not screen scraping. In the beginning, a lot of ESG data was basically scraping publicly available reports to come up with an quote ESG rating. And then there of course it's an algorithm. So there are some areas where that algorithm tries to fill in missing portions of the data algorithmically. Anytime you have an algorithm, it's programmed by a human being, so it's going to have a bias based in it. And I'm a computer scientist, so I can say that. Algorithms are programmed by people, and people have biases, unfortunately, that will find a way into the algorithm. There's never been a pure algorithm ever written. So what you find more often than not is this problem with the data. People will look at an individual holding within a larger ESG fund and say, well, this is greenwashing, or this ESG ETF is bogus because it has this in it. And I think what you're going to find more and more is companies that are really not trying to screen scrape, but are actually going into the individual reports to come up with the data that's actually hidden within the reports, not just what's in the table, but what's written in the text in the report to make an assertion of where that company really does lie on a variety of ESG topics. I mean, when you think about ESG, if we really look at it, there's like 168 factors, right, that someone would say is ESG. It's not just 3 letters. Think of governance. Governance covers a lot of different things. The number of minorities on the board, the number of women on the board, the number of women and minorities on the board, the representation of the board, the likelihood of the board, the turnover of the board, right? And that's just under the G of governance. So it's not that simple. And I think, Dan, you had mentioned earlier, and I agreed with you, that I think the worst thing about ESG is those 3 letters, ESG. We're trying to oversimplify something that's really not very simple. And when we think about why do people want these types of investments, it really comes down to a personal investing decision. If you think of the wealth management industry, they keep wrestling with, and they've been talking about for years, how do we have a more personalized experience with our client? You've got to talk to your client and understand their personal value set to have a personalized experience. You can't mail it in. There is no amount of drip campaigning that you can do that's going to get beyond that. And that's why I think, when you think about wealth management, we're a service-based industry. We're not a commoditization industry. And that's where things become really difficult. So I gave you a little bit more of a lengthy answer. I think ESG is really complicated with 168 factors. I think that today the technology and the disclosures don't exist yet. We're getting there. And a lot of the criticisms you see are people find these anomalies within a specific investment vehicle and go, oh, you're wrong. There you go. We're going to get past that relatively quickly, I think. And then we're going to begin moving even in the direction that I outlined in the book, which is, people are going to move quickly from ESG investing to either more SMA accounts or the new phrase, direct indexing.
There it is. I knew it was coming.
You knew it was going to come, Michael.
Yeah.
And we're going to go from direct indexing into really true activism. But what's driving all these trends? It's the need for someone to really have their money actively reflect their value sets. And that's what you're seeing. People want to be activists. They're just trying to figure out a way to get there.
I do think that it is in this space that direct indexing may make sense. When we talk about as a disruptor to ETFs, because ESG is so personal because activism is so personal. So to your point, one company can taint a whole experience. It's really difficult to package this stuff, these concepts in an ETF. I think this is where the opportunity for direct indexing really is. It's in kind of fine tuning this conversation, because I don't know that we can actually create a uniform data set for this stuff. I think it's kind of more of a pipe dream than an actual doable thing. So if this is really going to sincerely be more than just talk and actually trying to make this work for things you truly believe in and all about conviction, I think the ETF structure is a challenging one to package this stuff.
I think I would say there's a place for both, right? I'm going to go back to that activist investor arc that I invented for the book. A casual activist wants they really want to be invested in something that's close to their values. Think about a Christian who wants to invest in a Christian fund, right? That's close enough to my value set that I'm fine, right? Also, by the way, that your position in that activist investor arc changes over time. Really great example of that. For anyone who's had children, when you have children, man, things become real focused real fast, right? You don't have time for a lot of this other stuff that was going on before. So you may move from being an active voter to a casual activist, where an ETF fits my needs just fine. And then as my children leave the house and I become a little bit more conscious of that social change again, or I want to become more active, I can go back to direct indexing and an active voter, right? I think that it's not you're a casual activist and that's you forever. You're going to move through that activist investor arc. And I think that as a financial services industry, we want to provide a variety of products that address that level of activism in a person's life where they are today. Today, you may not be an activist voter because you have other things going on in your life. So you're going to be a casual activist. Tomorrow, you may become an activist voter. You may, a friend may get passed up for a promotion, which is kind of how Eileen gets into becoming a beginner activist. A friend is passed up for a promotion, and they basically turn around and say, wait a minute, what's the board of directors look like in this company? Why is it so heterogeneous? And should I be trying to take some action here? That may drive you to become a beginner activist. Without that catalyst, that one event, you could be an active voter or a casual activist for a long, long, long time. Some people may never get to that end. Like when we were talking earlier and you said the danger, there's maybe an inherent danger for having activists set directions of companies. I would argue that unless you really want to become a professional activist and you want to move through that activist arc, you're probably not going to be, unfortunately, you're probably not going to care enough to make that leap to say, I'm going to launch a proxy. I'm going to find these people. We're going to buy enough shares and we're going to do what we need to do to change a company. Not everyone wants to go there.
I love the idea of the hobbyist. I'm a hobbyist, investor, or a professional. I love that.
So Dan, you're going to take the last question. I want to stay on direct indexing for a minute, and then we'll let you go. Because I'm going to actually disagree with Cynthia. I think ETFs are a much better way to do this than direct indexing, and I'm going to tell you why. It's the wolf pack idea, right? Like, there's a reason they call it that. Right. And it's because you need other people to come together. So like I look at Adesina in our group, right, in our fund, Justice. They're going to the cohorts that are in their community to get unique data to decide which companies are really, truly social justice. We did work for Impact Shares on the NAACP one, right? I was with them yesterday. The new ESG rules coming from the SEC, they don't like the idea that you went to Black academic colleges to ask what's important to you. They want OWL ESG to tell you it should be important to them. Like, so it's like data gets people brainwashed. Now, the direct indexing, I don't think works as well as the ETF because you need the group. You need people coming together because I've seen it. Here's what happens. You go through the whole questionnaire with the client. You get to, this is what you want in the portfolio. You show them what the data kicks out and they go, well, where's this stock? And you go, it doesn't qualify because of that. Well, I want to own that anyway. Well, where's this stock? Why is this one in here? And so you're having the same conversation you are about the ETF, and you're going to have way more tracking error. And then there's that 1 year where, you know, the S&P's up 10 and they're down 5, and they say, why did this happen? So like, you can still have the client discussion and be the activist through an ETF and have a group to support it. Whereas with the direct indexing, you're defending uneducated decisions one after the other. Right. So I am Mr. Negative on direct indexing. I think unless you got $50 million and you're doing it for tax purposes, you're better off finding an affinity group, a wolf pack to work with, an Adesina for social justice, the NAACP for this, you know, Billy Bean and his crew for LBGT, like find an activist group. You may not agree with 100% of what they say, but it is what it is. At least as together, you can get something done. And I can tell you right now, 99.9% of people doing direct indexing aren't voting. They're not voting.
Before you answer his question,
I don't think there's a question
or
it's a rant. Yeah.
Along the same lines, you kind of teed me up, Mike.
Okay.
You know, one of the things that I've been very surprised about is that some family hasn't tried to, you know, promote their own ESG, their own messaging through an ETF or whatnot, right? And you know, a patriarch or a matriarch, rather, whatever, would basically launch an ETF, $50 million. Here are my values. And by the way, my family's behind my values. Otherwise, they don't get any money. You know, have you talked to any like very, very wealthy families who could or would or might, you know, pursue this type of route? Because I think the ETF is a better route because it does aggregate and pool the vote better.
I think so. I'm going to answer your question in two parts. The first is, yes, there are ultra high net worth that are looking at and saying, well, if I wanted to promote the same value set that I have, how can I go create an ETF and do something like that? Right. So I do think that you're seeing, and you will continue to see people poke at that and try to figure out where to go from there. You know, I think that, you know, the kind of that middle ground, if you will, is, you know, the Knights of Columbus, where they've launched an ETF, right? The Jewish American League, where they've launched an ETF, where, you know, if you're a faith-based investor, you have options now that will match your value set. So that you can just simply say, you know what, that's good enough for me for now. I'm going to do that, right? I think that when you start getting into that active voter, Mike's right. You find today that there's still a woefully small amount of people voting on proxy at any given time. So part of that is threefold. And I know this is, you know, one of them is pass-through voting would I think give more people the opportunity to vote their shares, which I don't think, you know, that's just not very much an option at the moment. The second is, I think that you would find if people had some better data around what's coming up for proxy, I think you'd find more voting associated with it. And number three, I don't think people really understand their proxy power. You know, if you talk to a lot of individual investors, they're like, yeah, I got this big thing. It was on this really thin paper. You know, it was in my mailbox. It looked really complicated. It was like 90 pages, so I tossed it. That's, you know, that's a crime, quite frankly, because that is your power right there. And you didn't understand what you had in your hand literally the moment you got it out of the mailbox. So I think part of that is around just financial education. What is the power that you do have as an individual shareholder? Because I don't think people realize that. So I answered your question, Dan, in three parts because I think it's a little bit more nuanced, right? But to Michael, to go back to your point for a moment ago, I think direct indexing, unless you have a professional manager who's going to be able to create that and manage it for you, direct indexing is not something it's not for the faint of heart, and you should have a professional creating that and managing it with you. That being said, most most RIAs have a $200,000 or $250,000 minimum, and there are a lot of kids out there with Robinhood on their phone that don't have $250,000. That are out there buying shares. They're trying to get together with like-minded people and drive their social agenda because they feel like they are locked out of the traditional financial services, wealth management advice because the minimums are so high in a lot of these cases.
Look, John, the one who makes out in direct indexing is the accountants.
Yes.
And that's another thing that the clients end up complaining about. I totally agree that it is valuable for somebody with a very high net worth who wants to be a true activist, right? So they know what they own and you know what that is then? That's just their personal account that they've done the real research on. It's not even direct indexing anymore. So hey, listen, this has been great. I'm going to share one more time. Here's John's book. Check it out. We want to thank him for being here today and joining us and all the insight. This has been a lot of fun. I mean,
this has been a blast. Thank you so much.
Yeah, we'll have a distilled of it next week out Tuesday. So there'll be a written summary and we'll probably have this one published on the YouTube channel. Obviously, we're taking next week off. I don't think you guys want to have a drink with us at the end of Thanksgiving. So, John, thank you for joining us. You've been a wonderful guest, and thank you to the team. And we'll see you after the holiday.
Happy Thanksgiving, everybody.
Thank you. Happy Thanksgiving, everyone.
Bye-bye.
Bye-bye.
Go ahead, Dan.
I just want to say I hope Eric Connolly gets home safe.
He's got the light on his hat. Yeah.
I've been stressed out with him on my screen.
Usually he's on a boat, so this is nothing. This is why we need to end daylight savings time. Will you guys be activists with me on that issue? Have a great night, everybody.
Bye.
Bye, everyone.
Bye-bye.
Thank you.